Hey everyone, welcome back to Corporate Decoder, the place where we decode the latest financial news, and let's just say this company has been busy tweaking its piggy bank arrangements. Today we are diving into a filing from C.O.P.T Defense Properties, or CDP. For short, this is a report that talks about some pretty important changes to their financing. Think of it like a big company updating its credit card limits and rules. So, what happened on the 6th of October 2025, CDP and its limited partnership, CDPLP got together with a whole bunch of banks. We are talking about big names like Key Bank, PNC Bank, TD Bank, Montana Bank, Wells Fargo, Fifth Third Bank, JP Morgan Chase, and Cinevis Bank. They all agreed to amend or change a big loan agreement that was originally made back in October 2022. Think of this as them renegotiating the terms of a massive loan. The first major change is to their revolving credit facility. This is basically a flexible loan where a company can borrow money, pay it back, and borrow again up to a certain limit. And that limit has just been boosted significantly. They have increased the total amount the banks are willing to lend or committed from $600 million up to a whopping $800 million. So, CDP can now access $200 million more in flexible cash. That's a pretty substantial increase, suggesting they feel good about their future borrowing needs or maybe want more breathing room. Now, let's talk about the cost of borrowing. The interest rates on this revolving facility are going to be a bit more complex. They will be tied to the Secured Overnight Financing Rate, or SOFR rate, which is a common benchmark for short-term borrowing. On top of the SOFR rate, they will add a percentage that depends on CDPLP's credit rating from major agencies like SP Moody's or Fitch. If their credit rating improves, this added percentage could go down, making the loan cheaper. If it goes down, borrowing gets more expensive. This really aligns the interest cost with the company's financial health, as seen by the big credit rating agencies. One of the most significant changes here is the maturity date. This is the date when the loan is fully due. It has been pushed back from October 2026 all the way to October 2029. That's an extra 3 years, and it gets better. They have the option to extend it even further, twice for 6 months each time. This basically means they have secured a much longer runway for this loan, reducing the immediate pressure to pay it all back. However, to get those extensions, they have to pay a fee, and crucially, they must not be in default on any of their loan terms. Now, let's look at the term loan, which is a more traditional fixed period loan. Similar to the revolving facility, the interest rate here will also be based on the SOFR rate, plus an additional percentage that hinges on their credit rating. The spread here is slightly wider, ranging from 0.85% to 1.700% above SOFR. Again, depending on the credit ratings, this means the cost of this specific loan is also directly tied to how well they manage their finances and how the rating agencies see them. For the term loan, the maturity date is the 30th of January 2026. Now, this might seem a bit sooner than the revolving credit, but they also have extension options here. They can extend it twice, each time for a full 12 months. The fee for these extensions is a little higher at 0.125% of the outstanding loan balance. Again, these extensions are conditional on not being in default and paying that fee. Here is a really interesting point. This amended agreement also gives CDPLP the ability to ask for even more money in the future. They can request up to an additional $575 million on top of what they already have committed. This can be in the form of increasing the revolving credit, taking out new term loans, or topping up existing ones. This shows a lot of flexibility and foresight, allowing them to potentially fund future growth or opportunities without needing to renegotiate everything from scratch. The key conditions, as always, are no defaults and lender approval. Looking at this whole deal, CDP seems to be focusing on securing its financial future with longer repayment terms and increased borrowing capacity. The changes to interest rates, tying them to credit ratings, also incentivize them to maintain strong financial discipline. The ability to tap an additional $575 million is a significant strategic move, signaling confidence in their growth prospects. One potential area to watch is the cost of borrowing. While tying rates to credit ratings is standard, the market can be volatile. If interest rates generally go up, or if CDP's credit rating were to slip, their borrowing costs could increase significantly, impacting their profitability. This is a classic risk for companies that rely on debt financing. Overall, CDP appears to be taking proactive steps to strengthen its financial foundation. They are extending their debt maturities to gain more time and increasing their access to capital, which is generally a positive sign for future operations and potential investments. They are essentially giving themselves more flexibility and a longer fuse for their financial obligations. Alright, that is our breakdown of CDP's latest financial maneuvering. What is your take on these changes and what they signal for the company? Future. Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out our Discord in the description. Thanks for watching. See you next time.